Hi, everyone. I'm Todd Rosenbluth, head of ETF and mutual fund research. Thanks for joining us for Can ETF Investors Still Get the Benefits of Stock Selection? We'll move to the next slide, and I'll introduce the rest of my panel, who you'll be able to see actually throughout the whole presentation on the screen. So we've got Greg Friedman of Fidelity. We've got Vinay Nadkarni, who's on the lower half of the screen here, but in the middle of this slide, from ClearBridge Investments, and then Dodd Kitsley of Davis Advisors. Thanks everybody for joining us, and thank you attendees for joining. Before we get too deep into this, I'm going to put a poll up for you all to respond to, which relates to the percentage that you have of your equity fund exposure through active management, and that's not index-based. So even though we're talking about active management throughout the presentation, we want to get a good understanding of the audience and where your overall exposure is. I'll keep this poll up for the moment as we'll move to the next slide, if we may, to just give an introduction to CFRA, who we are. We've been around for many decades, both as CFRA as well as the business that I came from at S&P Global. We've joined forces a few years ago to have our equity and fund research become part of the overall business. And now you can get a sense of the way that we are from an ETF data perspective. We'll move to the next slide, if we may, just to give you a better understanding also how our ETF research, we're going to talk about stock-specific ETFs. We do analysis of ETFs from a bottom-up, but we combine top-down research and analysis, looking at sectors and industries through a proprietary approach. We'll move to the next slide here, just to remind you that even though I've got colleagues here from Fidelity, from ClearBridge, and from Davis, CFRA is independent. We don't manage money. We don't cover ETFs that we have any financial relationship with. We're not creating financial products. It gives us a real good understanding of how we can be an independent provider and provide an objective approach to rating ETFs. Lastly, if I may, on the next slide, is just to show you the way that we go with a forward-looking approach, looking at what's inside the fund and what do we think about what's inside, offering risk assessments and cost analysis that's more forward-looking than some other firms that are out there rating ETFs. We separately rate mutual funds. Some of my colleagues on this panel may allude to mutual funds that they offer of similar in style strategies. We cover those too. You can learn more about that as part of a follow-up. Lastly, we'll move to this slide here to just give you a sense of the landscape before I then show the results of the poll, which I think you guys can see. Apologies, and I may need folks to be able to do that. I'll read the results of the poll if everybody can't see it. But the active ETF landscape has been really expanding this year. We've got more products that are out there, more money flowing to these products, as we'll hear from Greg and Vinay in particular, firms that are offering semi-transparent ETFs as well as fully transparent ETFs that both Vinay and Dodd are connected to. And I'm really excited that we've got this range of panelists that are here, because there's a whole host of equity products that we think are going to gain traction as investors get more aware about the structure of ETFs, the tax efficiency benefits of that. And you can see Davis is a good example of what has happened for a firm that has launched ETFs that are similar in investment style, not clones, but similar in the overall concept to pre-existing mutual funds. They've gathered nearly $1 billion in assets across the 4 products. Both Fidelity and ClearBridge are newer to the ETF space, and so I think they're building assets over time. But before I move us to the next slide, apologies if everybody that is here cannot see the results. It's actually a nice split. We've got 44% of the respondents. Here we go. I think we're sharing results now. 44% of the respondents have less than a third in active management, but also, more than a third, 36% have more than half. So we have a good mix of folks that are using active management alongside their index approach, which is great because we're going to talk a lot about active management. And so with that, Greg, I don't know if you want to add to this. Fidelity obviously has index-based ETFs, and you now have actively managed equity as well as actively managed fixed income ETFs. So Greg, I'll move us to the next slide to introduce you, but maybe you want to speak to what we just saw on the poll.
Absolutely. Thank you, Todd. Appreciate it. And thank you for having me today. It's not surprising. It's probably the right answer. We've been through, many conferences where in the early 2000s, there was a big argument. Do I go passive or do I go index? And the right answer is both. Here for me today, the same concept of do I go ETF or do I go mutual fund? The answer should be both. I mean, there's advantages for both. There's advantages, and you should be using both passive and active in an effective portfolio. So the results are not surprising, and in some ways, I'm pleased by seeing those results. So once again, thank you for having me here today. I'll speak a little bit about active equity ETFs from Fidelity, our concept, and my views on the industry. So if we go to the next slide, actually the next slide after that. The question people ask, why active equity ETFs? I've been fortunate enough to be involved with the ETF industry since 1996. And back then it was really truly US equity indexed ETFs. And we've seen a transformation and a phenomenal growth. Everyone's seen the charts of how the ETFs have grown over the last couple of decades. But started with US equity, gone to non-US equity, fixed income, emerging markets, frontier markets, commodities, and active, transparent. The one piece that's been missing from our clients' arsenal of investment tools is really the active equity, excess return. The industry's done a phenomenal job of developing. We've seen, and we've got two other great asset managers here developing products. We've got for our clients, every single slice of the index possible. We've got factors, we've got smart beta, we've got all the tools they need except for a real robust offering of active equity. How do I get my active equity? And historically, it's been in the mutual fund form. As we know, and we see here at Fidelity, the ETF user is different than the traditional mutual fund user. The client's different, the client base is different, how they think about it's different. So it's important for us at Fidelity to be leaders in the space and develop really an industry or sub-industry of active equity ETFs, the one piece that's been missing from, as I said, the client's arsenal. And really, it's an ability to combine the merits and the benefits of an ETF with the benefits of active management. You've got the flexibility, tax efficiency, transparency, liquidity, intraday trading of an ETF, but you also have the excess outperformance of a mutual fund or a active equity strategy. Our model, and I'll go into it in the next slide, really is intended to how do we provide outperformance, yet protect the integrity of the fund and protect our shareholders. So with that, let me go, slide 11, talks a little bit about tracking baskets. So as of today, there are 5 applications that have been approved by the SEC for these semi-transparent. Let me start off with, no one likes the term semi-transparent. Non-transparent is even worse of a term. We are calling these, and we believe these are active equity ETFs. We have active fixed income products that are fully transparent. We have active equity products now that uses proxy basket methodology. And it's not intended to hide the secrets. It's not intended for nefarious reasons. It's intended to how do we give excess return or the intellectual capital fidelity in an ETF form while protecting shareholders. And when I mean protecting shareholders, it's not just shareholders of that particular fund, but shareholders across our entire complex, because we use similar research across different products, different strategies. We use the same trading strategies across different products and different vehicles. So we want to keep that integrity, but we want to be able to produce a product that performs, that gives the investor the outcome they're looking for, but at the same time protects the franchise and really protects the industry. So we have a tracking basket methodology. So as I said, the SEC has approved 5 different methodologies. One is by Presidian, which is a blind trust, and the other 4 are tracking/proxy basket methodologies. Ours is a little bit different than the other tracking basket methodologies in that we use a very simplistic approach. It feels like an ETF, it walks like an ETF, and acts like an ETF. It doesn't force overlap. It doesn't force number of names. It's intended to how do I get a basket that has the closest and the best total return to that of the portfolio while also mirroring the same characteristics of that portfolio. So our basket optimization process rebalances and is an optimizer that we've self-built. It's in-house. It allows the portfolio, the track basket, at the same price discovery that you see on a traditional or a fully indexed ETF. And the tracking balance is also used for the creation and redemption of new units into that fund. Move on to slide 12. Our approach, as I mentioned before, is simplicity. We want to be able to produce alpha. We want to produce enough transparency that the secondary market can trade and make effective markets. And third, we want to make this as simplistic as possible. No extra plumbing, no new roles, no new players. It should fit into the ETF ecosystem. I've been around long enough in ETFs, as I said, 1996. I've seen what's worked and what hasn't worked. If it fits into the ecosystem, it works. If it's ultimately complex and creates extra work or needs that aren't currently part of it, it's not as successful. So we've built this process to really feel like an existing ETF. If we go into slide 13, our basket is no different than a basket you see in a traditional index ETF. The basket's produced, the authorized participants will create markets on that basket, or they'll use that basket for the facilitation of creations or redemptions. The shareholders, broker-dealer communications are the same, the exchange and the marketplace is the same. People ask me a lot, why Fidelity? And I think there's a couple of things I can point to. Is one, we want to be leaders in the space. If you look at our overall strategy, we have some indexed ETFs, but what we are committed to is how do we bring the best of Fidelity to our clients in both smart beta, which we've got some self-created indexed portfolios that are factor-based. We also have a family of active fixed income products. And now we have active equity. We want to be the leader of where active ETFs are traded. So we have a platform, we have trading platforms, we have analytics, we have websites, and now we have product. So our commitment to our clients, how do we bring the best of Fidelity into a platform that gives them the best execution and the best client experience possible? The other participants that have the technology are fantastic players. I've known all of them very, very well for many years. They've got some really neat ideas, some really sophisticated solutions for clients. But Fidelity is the only place that allows us to bring the best of Fidelity in terms of our research into product, as well as our platform and our execution capabilities. We can get lost in the different technologies. A bunch of us can sit in a corner of a cocktail party and talk about the different methodologies and the different nuances, especially Dodd. But for the client, the end answer should be, does my fund perform? Do I get the expected return I'm getting? And how's my client experience? That's really what should come to an end. So as an industry, we should come together. We should really think about the end client. How do we educate them? How do we talk about these new products? What are the benefits? And how do they use them in their portfolio? I think that's really the message that I like to leave today. We turn to page 14. We have 3 active equity ETFs that we've launched. These are clone-ish products, the emphasis on ish. These are the same managers that run successful, well-known Fidelity mutual funds using the same strategy. The ETF has to be run a little bit differently than the mutual fund. You can't have private placements. You can't have the illiquid names. You have to have a portfolio that's very liquid, easy to price, which allows the market maker to make tight spreads. Ultimately, we want the tightest spread possible on our products so our clients have the best client experience or the best trading experience. So these are clone-ish products. Not every product from Fidelity will be a clone-ish product. Some will be standalone new products. But we wanted to bring the best of Fidelity. And once again, we are wrapper agnostic. We don't care if it comes in a mutual fund, an ETF, SMA, or a model. We want to be able to produce the best products that our clients will use, because we know that the ETF client is very different than a mutual fund client. The mutual fund clients typically 60 years old plus from the middle of the United States. The ETF client is younger, a lot of female investors. They're looking for more sophisticated tools, ways to put together portfolios, looking at ways for asset allocation. So very different clients and very additive to the bottom line of all of us on the panel as asset managers. So we decided the first one should be clone-ish, because we already have the mutual fund version. In some cases, we have an SMA version as well, these same strategies. We wanted to bring these successful strategies out to our client base. They're all based at 59 basis points as an expense ratio, using the same portfolio managers that the mutual funds use. Moving on to page 15. Yeah, the first one I want to highlight, we've got three. This is our flagship of the first three, Blue Chip Growth. Since we've launched it, it's been about 20%. The fund is almost $50 million already after a couple of weeks. Strategic objectives is growth of capital long term. Sonu Kalra, who runs the mutual funds, also running this fund. Very strong performer and a very well-known product from a Fidelity point of view. With that, I know my time is up. I'll turn over to, I believe, Dodd, and I thank you.
Thanks for that. I appreciate Greg. We're going to come back to Greg for some questions. I've seen some questions that are already coming in. So please use the Q&A box that's at the bottom of your screen. And with that, Vinay, maybe you can tell us about what ClearBridge is doing. You have both what we'll still call semi-transparent and fully transparent ETFs within the lineup.
Sorry to disappoint Dodd. He probably thought he was going next there. So I thought this was a good transition because I think Greg nicely went through the mechanics of ETFs. I'm probably going to start with the philosophy of active management, and that's what I hope to accomplish in my kind of 5 to 10 minutes. So, I'd read a couple years ago a very good writer for Morningstar, John Reckenthaler, and he always said when somebody talks about active versus passive management, he always starts with the author and where they work, and then says works backward from the conclusion, because obviously we all bring biases to bear. So what I'd like to do, hopefully in these next 5 to 10 minutes, is give you probably a more academic view of what Greg talked about with the cyclicality of active versus passive performance and how you should think about potentially using active ETFs in your client portfolios going forward. So if you can go to the next page, Todd, I think here, what's really important, I wanted to really visually show that cyclicality of active versus passive performance. This is the last 35 calendar years of kind of S&P performance. You see the eVestment passive, which is a well-known database to track asset managers. What have passive S&P equity returns been in the left column, and in the right column being what the active experience has been in large cap core equity. And you can see that much like economic cycles, there are cycles where active will do well and passive will do well. It happens to be that one of the behavioral errors that we all make is recency bias. And as a result, because of this decade, people now ask the question to myself, Dodd, and Greg, does active add value? And so the recent past would tell you it's been tougher. There's still a path for outperformance, but it's been tougher. What I hope to go through in the next slides is maybe a case for why I think that case may at some point reverse, with a caveat. If you believe that the trend of the last few years is here to continue ad infinitum, you're probably better off with a passive or a factor-based strategy. But if you believe in changes in leadership and things that can kind of have tectonic shifts over time, we think there's a path for active performance. So if you can go to the next page, what I tried to do then was think about those 35 years and what have been the regimes that have been more positive for active management and which ones have been more challenging. High dispersion markets where stock picking and a broadening of that market is one where active management tends to do quite well. If you also look in those 35 years, market corrections, where you have the ability to really underweight certain stocks, certain sectors, can limit your downside. The flip side of that, and that's really more acute here in 2020, it's both of these. Markets where valuations matter less. Really, on the growth side of the equation, it's been which strategies have secular growth trajectories and valuation kind of be darned. And then low quality markets, and I don't think of that necessarily as leverage, but I think of that in that last bullet point where we talk about where liquidity is abundant. And right now you have such massive liquidity in the system, and you've had an abnormal period of both monetary stimulus and now fiscal stimulus, where we think liquidity is abundant, but there may be a period of time where liquidity isn't as abundant for the markets. And we think that that should be a good backdrop for active management when that reverses. If you go to the next page here, I think this is a good visual demonstration of what I just talked about. If you believe that the narrowness of this market and a few stocks dominating S&P returns, so for this calendar year, more than 100% of the S&P's returns are by the top 3 stocks. What I chose to do here was look at the Russell 1000 Growth Index, where a lot active management has even been more challenging over the last couple of years. And you can see this kind of last 22 years. When you saw the rise of the dot-com bubble, and people think of the type of, pets.com without revenue, but really it was a mega cap bubble as well. You had names like Microsoft, Cisco, Procter and Gamble, Walmart, all trading at above 50 times earnings. It's not that those weren't real companies with real revenues. It's just they had become overvalued. And when you saw that decompress, when that concentration became high, there was a perception these are going to be the great companies for the next 20 years. Well, some of them ended up staying that way and some of them didn't. And that next decade became a very good period for active outperformances if you tie that back to page 19. What you've now seen in the last decade is really, again, this idea of few companies winning. So Todd has nicely moved to our ETF strategies. And what I think, where I see portfolio construction going forward, and Todd nicely asked this in the poll question, I view that portfolio construction won't be large cap growth or these type of things. It will be market beta, factor-based strategies, and idiosyncratic risk. That's how people will construct portfolios going forward. And we try to figure out within that idiosyncratic bucket, how can we construct a portfolio that provides a differentiated outcome from passive and factor-based strategies. And we do it through high active share, where the primary attribute is excess return and more consistent excess return. Income solutions, where you're trying to provide either superior current income or income growth relative to a passive strategy. And lower volatility, where your alpha is really generated during drawdowns and a downside protection element. So if you can go to the next page, Todd. I think another reason that we believe that active management can add value is ESG integration. And that's because right now, so much of the market in ESG is self-reported and hence doesn't have statistical significance. There is no Reg FD around ESG reporting. And from a ClearBridge perspective, we've embedded that ESG research within our fundamental research team, as opposed to having a separate team doing this work. Because from our perspective, it's really critical to think about, is this material to the thesis of the company, not just material to society? So what you're really trying to do in our ESG work is marry these two concepts. Really think about sustainable concepts where you're thinking about the investment horizon for our portfolios being several years. Our portfolio turnover across the firm is about 15%. So a 7-year investment horizon for our strategies, but then do it with the idea of let's really find the ESG considerations that are material for the company. So if you kind of go to the next page here, Todd, here's some summary of some big picture takeaways, right? 1, understand the cyclical nature of active and passive and the regimes that are tailwinds for each of them. 2, investing passively does not completely insulate investors from fluctuations in relative performance. You can still, right? Asset allocation is going to matter. And what I would say is you want to have market exposure. You may want to have some factor exposure, but you're going to need to create some excess returns for many of your clients to meet their end financial objectives over time. And then I think the biggest one that is underestimated because of recency bias is that concentration risk is growing in passive benchmarks and in factor benchmarks as momentum extends its market leadership. I'll kind of close with my one, hopefully, commercial for ClearBridge, and that is what our lineup is. And so our 4 ETFs on page 25 are really these strategies. The all cap growth and large cap growth ESG ETF are in that high active share camp. The dividend strategy ESG, priced at 59 basis points, is in that income solutions camp. And then the focus value, which is using the Presidian structure, is a sub 40 stock portfolio priced at 49 basis points in that low volatility. To us, value investing isn't about reversion to the mean. It's compounding of quality and returns over time. And so that's our lineup that we think provides us a continuum around those ways to outperform in active management. So with that, Todd, hopefully I'll donate some time back to Dodd and he can take the baton.
That's great. Well, thanks, Vinay. We'll move us to the next slide. Dodd, on behalf of Davis Advisors, it's been around almost 4 years with actively managed ETFs. Great to have you round out this lineup, and then we'll come back to everybody for Q&A.
Awesome. Thanks, Todd. And it's such an honor to be here with such a great panel. It's an exciting time, both for active management as well as the ETF industry, where we're finally seeing these kind of two worlds come together in such a big way that we've waited for a long time. I know I've personally waited for this for a while, and Davis may have been early, and it's okay being a green banana, I suppose. We're so excited, and this is going to translate into so many great things for investors, driving down costs, increasing efficiency, and really expanding the toolbox to being able to access great strategies in an ETF format. And the stats you gave at the beginning, certainly actively managed ETFs are still only 3% of the overall industry, but we're seeing some real innovation and growth with 66 new products already this year, over 100 over the last 12 months. So I think we're really just at the beginning stages of a real catalyst for growth in the ETF industry and a real change. And what excites me so much is that we're challenging this common misconception that we've all probably faced, that investors think about ETFs and they automatically think ETFs are just about indexing. And they're so much more than that. And that's maybe a statement of the obvious for this crowd, but what ETFs really are is just being able to create a more efficient way to get exposures. It could be indexes, they could be asset classes, and the big conceptual leap now is it's strategies, and strategies that can be human-based, based on experience and qualitative factors and things of that nature. So let me get into the slides before I talk too long. Essentially 3.5 years ago, Davis was really fortunate to enter the ETF industry. We're among the first to offer actively managed equity ETFs. Really what these are a combination of two wonderful things. It's time-tested, proven active management with a traditional ETF format, and combining all of those sort of things. And like Greg, I've been in the ETF industry for a long time. I've been described as an evangelist for indexing, so it certainly turned a lot of heads when I joined Davis. And it excited me not only about the opportunity that this is like version 3.0 of the industry, but I got to be honest, I was really skeptical in active management, having drank the Kool-Aid on indexing. And don't get me wrong, indexing is so powerful, and Greg said it right. It's the best portfolios bring both of these sort of things together. But I think the world looks at active management in the wrong way when they're looking at the average active manager. And that's why I joined Davis. It's really, they checked all the boxes, because we can all admit there's a lot of bad active out there. There's high fee, there's folks that look a lot like the index. There are those that are not aligned with investors in terms of eating their own cooking and having skin in the game. Davis checked all those boxes. So it was exciting to me to have the potential to bring an active strategy with all of the benefits that ETFs offer. So going to the next slide, really quickly, these are our 4 ETFs. Essentially, we're a very focused shop. All we do is equities. We're equity specialists. And the 2 questions that I get most often about our launch is the why and the how. And if I could spend a minute or 2 on those, I think it'd be interesting. The why really is as simple as our existing mutual fund clients asked us, and we were finding that a lot of advisors were seeing the benefits of ETFs, and they asked a simple question: why can't you deliver your strategies in an ETF format? And to the firm's credit, we did a little bit of look, and we essentially were able to launch these. And we draw a lot of parallels back to actually the genesis of Davis Advisors, because we actually started out as an institutional shop in the 60s. And Shelby Davis at the time was approached with a very similar type of question. Why don't you offer these things called mutual funds? And that was really how our firm began in 1969. Then in the 90s, we had the same question on SMAs, launched SMAs. And in 2017, we launched the ETFs. So for us, it's all about choice. The how is often another question of why were we early? Why were we a green banana, so to speak, before folks began to even look at this category? And it really has everything to do with the way we manage money. We were fortunate in that we own large liquid securities. We have very low turnover. We have a very long-term time horizon. So that afforded it to being fully transparent in a traditional ETF structure. We didn't have to wait like others did for a semi-transparent or whatever we want to call these other great structures and strategies. So we were afforded certainly that benefit. And then the firm has a culture of transparency as well, which certainly helped accelerate that process. Going to the next slide, just to, at a high level, describe what our portfolios deliver, whether it's large cap, financial, international, or global, we are very selective. Our ETFs have 25 to 35 names. We believe in that high active share is an important component of good active management, as Vinay highlighted. And then the companies that we look at, we're really looking for companies with above average long-term earnings growth that's sustainable, and those that are undervalued. So we think we compare very favorably relative to the benchmark, and we also pair very well with the benchmark. On the next slide, just an example of DWLD. It's one of our more popular ETFs. It's global. It's our totally unconstrained portfolio. And just want to drive home that we think that what you do own is as important as what you don't own. And you want your high conviction names to really be able to play out. And a great example is our #1 holding in DWLD, which is New Oriental Education, symbol EDU. It's a 7% weight in our portfolio. It's only 4 basis points in the underlying index. And this is a company with tremendous management team. It's dominant in a segment of after-school education in China, where you have a population of 250 million K through 12 school-age children that are clamoring for extra education to be able to get ahead. This is the industry leader, and we think it's going to continue to grow. And we don't want a 4 basis point weight. We want a 700 basis point weight. Next slide. So just a couple perspectives on today's market from our research team. You know, we do believe one of our competitive advantages is our investment discipline that's been consistent yet refined and enhanced over 51 years. But the other real, I think, competitive advantage is our long-term perspective. And I think that particularly plays out in today's market. We urge investors that investor behavior, controlling your emotions, is incredibly important. That's really the value of a financial advisor. We think it's also value of an asset manager, and it gives you perspective to be able to identify opportunities and focus not on short-term predictions, but rather on longer-term probabilities. So next slide really just kind of shows that we are just swamped with a lot of these short-term predictions that we'll be the first to admit we have no idea where they're going to play out. There's more uncertainty today, you could argue, than in any other market. The volatility and sell-offs and run-ups is nothing new. You can expect that all the time, and that's what we prepare for. But the next slide is some longer-term probabilities, and we're realistic, but we're also very optimistic and have extreme confidence that the economy is going to reopen at some point and get back to whatever normal is. We're going to have a vaccine. We're going to get through these sort of things. And with that, as an overlay, the next slide just highlights some of the companies that we look for and what we look for in a company. And then first and foremost, particularly in this environment, durability, adaptability, and resiliency. Companies that are able to kind of be able to withstand the short-term volatility and be able to come out the other end and be able to really grow. Those with great management teams and a great culture, and those selling below their intrinsic value. And we think there are a lot of those out there today, despite the run in the market. And Vinay highlighted it really well. It's really been driven by a handful of stocks in a handful of sectors or particular industries. Next slide will just kind of go through what we're avoiding. And at a high level, it's really industries with high fixed costs, high debt, and plummeting revenue. And there's a lot of these out there. And ironically, these fall into industries that in the last period of volatility coming out of the financial crisis, it's things that worked and where people felt comfortable. Things like utilities, things like high dividend payers. We say don't paint a broad stroke. Where people feel comfortable often poses the biggest risk. And then where we're finding opportunity on the next slide, really it's in 2 categories. It's in global industrials, which we think are very mispriced based on trough earnings. And then financials is perhaps the most mispriced industry sector in the entire market. And we think that it's really the biggest fat pitch that our research team has seen since the divergence in growth in value in the late 90s. 3 drivers for this. First, the banks are really in their strongest position that we've seen in decades. They have twice the cash they had going into the financial crisis. They have a better credit profile than they ever had, yet they're priced as if they're going out of business. The market, for the second reason, is not appreciating the long-term earnings potential that we see in financials for two reasons, again, based on trough earnings that we've seen, as well as some gap principles that are recently introduced where these companies are taking full estimated loan losses in recent quarters in expensing that. It's crazy, it's underestimating, and we're looking at financials being incredibly undervalued. If you look at normalized earnings, even taking out the next 4 quarters, we'll see some banks trading at 5 to 10 times earnings. So with that, we just wanted to leave you with a flavor for kind of the way we think about the world, where we're seeing opportunities today. And we're so thrilled to be able to be in the ETF industry and be able to deliver these in a vehicle that, you know, investors really are voting with their dollars.
Thanks, Don. I think we'll go through just the next couple of slides that are disclosures that'll appear on the screen. We'll start us off with questions that have come in. We're going to have a few of them that are going to be for everybody, so I'll call on folks so they can unmute themselves in the interest of it. But all of you all offer both active mutual funds, and Greg used the term clone-ish in relation to the differences between the ETFs and the mutual funds. So given that we're doing this with mutualfunds.com, we just talk about Greg, I'll start with you. Can Fidelity's active ETF business grow at the same time that the active mutual fund business, or it can only be market share gaining from one or the other? Is there room for growth?
Absolutely. You know, people always talk about in the industry cannibalization. You know, will everything move from the mutual fund to the ETF because there's limited dollars? The answer is no. You know, the mutual fund has a different client base. You know, some aspects of the mutual fund are, you know, superior to the ETF. Some of the ETF better than the mutual fund. So as Fidelity found, you know, as we built our ETF enterprise, we're over 19 billion in assets after 6 years. The clients coming to us are new clients. It's new dollars, new wallets. We've had a couple different situations to be able to start to look at it through cannibalization, you know, through our sectors, index ETFs versus our active sector funds, our fixed income active funds, and now our active equity. In all 3 cases, we didn't see cannibalization, we saw new dollars. So, you know, the ETF user is still developing. It's still a relatively new industry. It's really started in earnest in 1994. And these are new dollars. So there's plenty of room for growth. Plenty of room for growth on both structures. And it's really, you know, how do we as an industry create innovative products as part of this panel, you know, on the active side that the ETF user is looking for.
Don, I'll go to you. We won't go straight down every time, but I'll
Sure.
go to you. You've talked about this being analogs of those strategies for similar reasons. Is there a different audience for the mutual funds and the ETFs, or do they cross over?
Yeah, it generally is a different audience, as Greg was you know, referring to. It's often a very different investor base with different wants and needs, and that was our whole strategy. It sounds like, you know, it's certainly the strategy of others as well. If you're having analog type of products, right? We want to be able to deliver our strategies to advisors in the investment community in the way that they want to be consumed. And it would be a shame if folks ran an ETF book, they liked our strategies, and they're like, oh, sorry, we can't get Davis because you don't have an ETF. So there are subtle differences that can certainly drive based on the wants and needs of both the advisor's practice as well as the end client. Tax efficiency, it could be temperament. There's a whole host of reasons, and we wholeheartedly believe, as Greg does, one structure is not unilaterally superior than the other, but given choice is really the right thing to do and in the best interests of our industry overall.
Vinay, I'll just ask you to add to that. I'm sure you have a few thoughts.
No, I think that's exactly right. I think, look, in some ways, people try to make this a simplistic thing. They think of ETFs as Uber and mutual funds as a taxi. And I always tell people, will there be taxis? 20 years from now? Probably the answer is yes. People have habits. I think that, and some people just have preferences, and some people embrace technology differently. And so I think that's, I think we've taken the approach of, we try to deliver a strategy, and as much as possible, we vehicle agnostic. Some people like it in a model delivery SMA. Some people like it in a mutual fund. Some people like it in an ETF. In the retirement market, you're seeing the growth of collective investment trusts. So I think what you're trying to do is, the wrapper isn't the star, it's really the strategy, right? And now you want to have a vehicle that implements and that you can do that in as effectively as possible. But that's what, our expertise is in the manufacturing, not the packaging.
Great. So I'll flip up the order. Again, this is for everybody, but cost is obviously something that is top of mind. And there was a couple of questions that came in related to the premium that you pay for active management. Dot, I'll put it to you. How does Davis think about how you're pricing the strategy? Is it in relation to index-based ETFs? Is it in relation to active mutual funds? Is it in relation to active equity ETFs? What is the ballpark people you think should be looking at?
Yeah, it's a great question. So market exposure, beta exposure has been and should be inexpensive. And that's why we're seeing 3 basis point products to get broad market exposure. You're just following, a rules-based index and getting exposure. That's become commoditized. It doesn't make it a bad investment vehicle, but certainly that is one aspect. Price is what you pay, value is what you get. I know it's a common saying, but we believe that we can outperform. We have a track record of being able to do that, and there's cost involved in terms of a research team and visiting companies and doing things of that nature. The one thing I will say about cost, and we were very, very intentional on this when we launched our ETFs, is we did not want cost at all to be a driver in terms of what vehicle folks use to access Davis. So we charge 55 basis points of every dollar of equity we manage from a management fee. The expense ratios for the ETFs are a little bit lower because shareholder accounting costs are slightly lower, and they really should be. But all net, you're paying the same amount for our ETFs as you are our mutual funds, within a basis point or two.
Vinay, I'll twist that a bit to you. Do active ETFs have to be lower than mutual funds to get investor attention, or is there room for an audience regardless?
Look, at the end of the day, I think in the active space, people want differentiated return streams, right? So we've never felt like, look, this entire industry right now has some deflationary forces. Even the people we distribute to, right? Like, one of the things that's going to be a tailwind is commissions used to be there for ETFs. Now, for most people, there won't be. And so you're trying to just reduce the total cost of ownership. Part of that is the management fee and the end expense ratio, but part of that is the transaction cost, which are also kind of deflationary. And I think in any vehicle, people have to understand that those things are more likely over the next 5 years to go down than to go up. Our philosophy is to provide a fair fee, what we say is below median. We're not intended to be the low-cost provider because we're not trying to, our fundamental process isn't trying to be the low-cost provider. We're investing significant resources in, it's like R&D for us. And so it's like value over a generic drug. The question is, what should you price for it? And I think that much like the healthcare industry, where there is some deflationary forces, some regulatory forces, I think the same things are going to be there. But our active ETFs are all in the kind of 49 to 59 range, where I think we're all in the same kind of ballpark, and that feels very fair right now.
Greg, anything you'd like to add from a cost perspective?
No, I mean, our philosophy is, we want to offer our clients value, choice, and value, choice, innovation. So for us, innovation is how we bring the best of Fidelity to our products. Choice, you can choose whatever wrapper you would like. We're wrapper agnostic. And from a cost perspective, the ETF should be a little cheaper than the mutual fund. You don't have the TA cost. You don't have some of the same structural costs. So yes, the industry is expecting the ETF to be cheaper than the mutual fund. But in our mind, it's not. It's to Vinay's comment, we're not looking to be the low cost provider. We're trying to stay agnostic in terms of, what does it cost us to manage it. But from a structural perspective, because there's no TA cost, the ETF is and should be cheaper than the mutual fund.
Thanks for that. So Vinay, you had earlier on one of the slides looking at how ESG is part of the process. Maybe you could just expand on that a bit. You know, ESG tends to be more index based, but I think the audience would benefit from hearing how you guys are integrating it.
Well, I think the key for people to think about is, right, there's so many acronyms that the financial industry loves to make overcomplicated for everybody, right? So it used to be SRI, which is socially responsible investing. ESG means environmental, social, and governance. And what we would say is the industry has evolved, I think, on that. And if you think about our European clients or non-US clients, where this is probably a little bit more top of mind, but certainly in the high net worth space in the US, it's increasingly top of mind, and with institutions as well, is that people don't want to exclude names. You want to maximize your opportunity set. What you're trying to do is within that is which companies have the best sustainable path for outperformance given our time horizon. And so, like I said, I think so much of financial information is ubiquitous now, but there are things that are self-reported and those type of things. And so for us, ESG integration at the fundamental level, I think allows us to really understand intangible value. Dodd went through this nicely about areas to avoid, and there's a lot more premium in the market around intangible assets. The market 34 years ago was much around tangible assets. And so that IP, part of that is culture. Part of that is so many things that you're trying to assess. And so to me, it's just a reframing of the fundamental intangible characteristics that you're trying to value about a company and its operating strategy.
Thanks for that, Vinay. Greg, Fidelity's, we're in the early innings of the active equity ETFs that you guys are offering. You're also, I believe, licensing out the technology that's behind that to some other asset managers. How do you see the active ETF landscape evolving and growing?
Thanks. Now this is, we are very early. The first preceding active equity ETF was in April. Our first three were in June. So we are still very, very early in this. And I think, there's a lot of discussion right now around the different technologies, which one's better. But as I said, down the road, and people should really be focused on what does your fund perform, what's your client experience, and then how does it trade. For us at Fidelity, we're looking at this as a long term. Yes, we are using the technology for our own funds, but yes, we're also licensing this out to other third-party managers. We want, as I said earlier, want to be the home of where active ETFs are traded. Between our own funds, our partnerships with the licensed technology, as well as our execution capabilities, to Vinay's earlier point, we trade all ETFs and stocks with zero commissions. So we want to make this, as seamless for our clients. And when we look at this is not active equity ETFs aren't going to be something that are judged in weeks and months. This is going to be months and years. Most ETF providers, start looking at funds in terms of how we think about them for 2 or 3 years. A lot of education has to go into this, and we focus as an industry. And I have a product background, so I tend to be on the product side. And we'll have 20, 25 products of these new active equity funds in 2020 with maybe $1 billion of assets or a little bit north of that, and that's great. But I think the biggest impact is not going to be that. It's going to be the distribution. Because how these active equity ETFs are created changes the distribution strategy for how traditional mutual funds, traditional wirehouses, gatekeepers, how do you think about this? Is really changing the way that managed products are distributed and charged for. So I think because it's such a large invention and innovation for the industry as a whole, it's going to take time. And I think the early adopters are going to be direct investors, advisors, independent advisors, and then it'll go upstream over time. But this is a long game. This is a fantastically interesting and exciting time, but there's going to be a lot of change beyond just the product front.
So Dot, I'll ask this to you, and then Vinay, maybe you can offer some color as well. You have ETFs that are disclosing the holdings as of yesterday on your website, and that we at CFRA and others are using. How is that something that the management team was comfortable with, since they're analogs of the mutual funds that don't disclose holdings the same day?
Yeah, it really is not and hasn't been a concern for us, again, because of the nature of the way we invest, being large cap, having low turnover. The securities are very, very liquid. It really, the traditional concern is front running. Davis is a boutique shop, so we also have the luxury of not being ginormous, and this being, a analog of a $200 billion fund. But it's cognizant. We are very cognizant of that, and it also is one of the things where we put limitations, where we'll omit some of the less liquid securities that we have in the mutual fund, just to kind of eliminate any of that concern. But in the 3.5 years we've been doing this, we haven't had any abnormalities in terms of trading or concerns from that. So.
Okay, thanks. Vinay, how about you? You guys are running 3 of your 4 products, I believe, are disclosing holdings as of yesterday.
Yep. So I'd say one, we chose intentionally to not clone any of our mutual funds. They're actually, I would say, more clones of our wrap separate accounts. And that's an important consideration. So that's point one. Point two is, like Dodd said, we intentionally chose not to do that with any small cap portfolios or those type of things. We're large cap and we have long investment horizons. So our competitive advantage isn't our trading and darting in and out of stocks. It's really strategic long-term allocation, frankly, exploiting volatility. And then the third part is, as I said, Dodd said this with Davis's evolution, we've been doing wrap separate accounts for advisors for 25 years. By the way, they see our holdings every day. Somebody can open, on Fidelity's platform, they can open a wrap separate account with us for $100,000. The barriers to entry are not very high to see what we do. So the question is, how valuable is that to the industry? And I think, given that we're probably a larger player in assets than Davis, but we're not a mega company either. So I think that kind of willingness to have transparency that we've been familiar with, it wasn't a cultural hurdle for our portfolio management and our business side to overcome. So we have oars in both sides. We have the transparent side and the semi-transparent side right now.
Great. Well, Greg, I'll give the last question to you, which is somewhat a response to that. I've used the phrase semi-transparent more times today than normal, but I'm saying it regularly. I don't think that's a phrase you're using. How are you describing your products that are not semi-transparent but are something else?
We're just calling them active equity. People are getting wrapped up in the technology. As I said, people like Don and myself can sit in the corner at a cocktail party and talk about, well, one model versus the other and the percentage of overlap. No one would be around us, but we'd be, having that discussion in the corner. It shouldn't matter. As I said before, it's how your fund perform and what's your experience. But with that being said, the term semi-transparent has become put out there because of the nature of these proxy baskets, tracking baskets, or in the case of Precidian, the blind trust. And I don't really think that's really a fair representation, because if you look at some of the indexed, traditional, in some people's minds, ETFs, when you look at non-US equity, emerging market, frontier markets, those are optimized. Some of the indexed fixed income products are optimized because you can't take in-kind creations of mortgage pools. So this has been something we've been doing for decades, is optimizing portfolios so they're liquid, can be priced, and lead to very tight, effective trading of these products. So this is not that far different. Now, it's different in that we don't have daily holding disclosure, but the baskets are not that different than some of the other asset classes that exist today. So we don't want to get stuck in the nuances. We don't want to have to be talking about this. We have indexed, we have smart beta, we have active, and this is just an active equity ETF. And we think that's the best label and moniker that we can create for our clients to alleviate confusion and be very transparent on what it is.
Got it. I appreciate that. I'll move us to the next slide here, which is just a teaser, if we can, back in the presentation, about some of the other webinars that CFRA is a part of that we're hosting on our own platform. Road to the Recovery. We have one coming up next week on healthcare. In September, one on infrastructure and one on real estate. This is leveraging our equity research team. So I head up the ETF and mutual fund research. And folks that want to be able, I've gotten a number of questions about how these ETFs have been performing. what do they hold? Rather than my ask the panelists to be able to answer that on the fly, I'd welcome you to go visit our platform, Market Scope Advisor. You can obviously go to the fund company's websites as well. They're disclosing their performance information and other key metrics that are there. And I'm sure they'd be very happy to answer more questions that you have specifically about their products. The next slide here is just my thank you to the panelists and my thank you to you for sticking with us on a Thursday, and appreciate you being a part of it. Greg, Dodd, Vinay, thanks for joining us. CFRA has been happy to be hosting this with Miter Media, and we're happy to do this going forward. So with that, I think we've got a couple other disclosures that need to hit the page just so that we all don't get sued. And with that, everybody, thanks. A pleasure being part of this. Have a good day.
Thank you. Appreciate it.
Thank you.